Okay. Thank you for joining Withum's annual Business and Finance Symposium. The theme for this year is Driving Financial Strategy Through Economic Change. My name is Austin Hageman, a partner and advisor for Withum Wealth, our white glove wealth management solution bringing clients the resources of a multi-billion-dollar investment advisory firm. When I'm not behind the desk, I'm also a host of our personal finance and investing podcast called Amplified Wealth. It is truly a pleasure to be with you all today and help kick off this symposium. We are so excited to have over 1,000 plus registrants. What a great turnout. Over the course of this symposium, we will share expertise in SALT, A&A, artificial intelligence, and much more. You'll leave the symposium with not only new insights and great conversations, but also up to 10 CPE credits. That, folks, is what I like to call a win-win. Before we get started, though, a few housekeeping items. Please remember that you may join as many or as few sessions as your schedules allow. Each session, including this one, will have a chat feature, and our presenters will be happy to answer any questions you may have. There is about a 45-second delay in receiving questions in this specific session, so make sure you get your questions in when you can. In order to get CPE, you must record the codes that come on the screen throughout the presentation, so make sure you pay attention for those. Once you are done attending all of our sessions, you can head over to the certificate tab to obtain your CPE certificate. So without further ado, today it is my pleasure to introduce Dr. Klaus Tewildt. He is a distinguished financial services executive and respected thought leader in asset management. Klaus is known for simplifying complex global investment topics for advisors and clients. He is a frequent speaker at major industry events, including Merrill Lynch, UBS, and Wells Fargo conferences. Klaus is the former head of capital market strategy at Fidelity Investments, where he spent 18 years. He was the creator of Fidelity's Investment Themes Market Outlook series and co-hosted the podcast Thinking Outside the Portfolio. Klaus co-founded Tamac Investments and was a former executive at GT Global, Dressner RCM, and Bain and Company. He currently consults on portfolio strategy, crisis management, client communications, support of client acquisition and retention, and executive coaching. Now, please join me in welcoming Dr. Klaus Tewildt. Welcome, Klaus. So glad you were able to join us today.
Thank you, Austin. It's a pleasure to be here. Good afternoon, everyone. So let me get started. You see the title here, and so let me just say up front, I will have to talk about our president. And I'm going to do this in a way that I personally consider neutral and objective, which will mean that at any point in time, I will make some of you angry because I'm going to criticize him and I'm going to praise him. So please don't get mad at me. I'm just trying to tell you what I think is going on with the economy, what is going on with the actions and policies he is pursuing. So let's get started. And let me share with you what I've planned for today. At first, I wanted to sort of start off with a little bit of a backdrop of what has gotten us here. Why did he become president, and what are the implications for it? Then I want to talk about what President Trump is trying to accomplish here, what it will mean, in my opinion, for the rest of 2025 and 26, and what the two biggest risks that I see for the economy going forward next year and beyond. And then I just have some final thoughts. And at the end, as Austin mentioned, if we have about 10 minutes for question and answers, and Austin is going to come back in here, and he and I will go through the questions then together. So let me just provide sort of the backdrop at first, and I just want to go back to 2005. Since then, we had in the US about 11 elections, and in these 11 elections, and 10 of those, at least one branch of the US government was replaced. Either the president, the Senate, or the House. There was at least one change at every election. So the electorate basically has kicked out at every election because they were angry and mad that things have not gotten better. One leadership of one of those branches. The only exception was in 2013 when President Obama retained the presidency. John Boehner remained, or the Republicans remained the House leadership, and Harry Reid was still running the Senate. And in all other ones, the electorate has changed at least again one of the leaderships of one of those branches every time. And if you look at the elections yesterday, you can see it might be happening again next year during the midterm elections. There's a political analyst that I trust, that I know very well from Wall Street. He believes that the Democrats have now a chance of about 75% to get back the House next fall. So what is really important, though, about this is that this is not just an US phenomenon. There is really an age of discontent, and it's global. Germany's chancellor had to resign at the end of last year. They have a new chancellor, Chancellor Merz, who was elected in May. The UK went through 4 prime ministers since the summer of 2022. Prime Minister Trudeau had to resign last fall, and Mark Carey is now prime minister. Japan went through 5 prime ministers since the summer of 2020. South Korea had 3 presidents, and France, President Macron is at the moment struggling to put a government together. So the electorate is mad. And the electorate, if you look at what they're mad at, it's for all developed countries the same issue. Lack of economic and wage growth, a lack of having an increase in their living standards. And just to highlight a little bit what happened to economic growth, you can see the numbers here. In red, you have the global GDP growth, in blue, the US one, and in gray, global ex-US GDP growth. And you can see that over time, the amount of GDP growth has really shrunken every decade. We went from, let's say, 10% growth in the US in the 70s to 8 in the 80s to 5.5 in the 90s, 4.2 in the 2000s. And then we sort of stagnated over the last 20 years in the area of around 4.5%. And that lack of progress has really made the electorate very mad. Part of the problems were that inflation got a little bit higher during COVID, and there's discontent with the amount of illegal immigration. And again, not only the US, every other country, maybe with the exception of Japan and Korea that I just mentioned. Aging demographics make our deficits a lot more difficult to deal with. There's lack of affordable housing and healthcare and climate change. And just to sort of put a number on the lack of affordable healthcare, you might have seen in the Wall Street Journal there was an article last week that pointed out that if you have to pay for your family for health insurance on your own, it's not subsidized by your employer. You have to pay it on your own. That would cost the average American family about $24,000 a year. The average American family makes $60,000 a year. So that is a number that the average family will not be able to afford on their own. And we all know that the housing is an issue. I have 2 kids. They are both in their 30s. They have master's degrees. They have good jobs. They cannot afford a house. And so this is really why Trump got elected here, is to fix these issues. And that's what he's going to be measured at next time when we have an election, the midterm. So what kind of policies is he pursuing to solve these issues? And I've tried to summarize this as 5 bullet points here. The first one is that he's raising tariffs on foreign goods to make them more expensive. And at the same time, he's providing a lot of tax incentives for local manufacturers to bring these jobs back into the US to build those plants. He is reducing illegal immigration. The idea is to promote higher domestic wages. If you shrink the labor pool, you probably get higher domestic wages here. And he's also hoping that if you deport enough illegal immigrants, you are freeing up some housing stock that would then be available to Americans, hopefully at lower rents. Um, he is proposing to, or he is increasing domestic energy production, predominantly in oil and natural gas, but also in coal and nuclear. And he would like to win a Nobel Prize for peace, but what he also would like is to bring oil prices down, and that's why he actually would like to have peace in Israel and Palestinian peace in the Ukraine, because if you have peace there, the premium that is currently on oil prices because of risk would go down and oil prices would fall even further then. Secondly, or fourthly, he wants to strengthen the economy with lower interest rates and deregulation. And there are a lot of personal tax refunds coming. You probably are aware of this, but I will get back to this in a second. But there's a lot of stimulus coming through these personal tax refunds and coming in 2026. And last but not least, this faster economic growth and the tariffs revenues that the government is collecting, plus the cuts in government spending through DOGE, he thinks is going to ultimately fix one of the bigger problems that we have, is bringing down the deficit. So in a nutshell, that is his plan. Let me just say up front, this is not a bad plan. This is very, very reasonable. It attacks the main issues that the electorate is dealing with, and if it is successful and is achieving all these goals, I think all of us, even if we don't like President Trump, all of us should be very happy that this is being achieved. I have three major issues with this, and I'm going to mention the first one now. The other two I will sort of cover a little bit later on, where I think from an execution perspective, it could be better. And I want to talk about tariffs here first, because I'm not going to touch them later on, but many of you might be interested in the tariffs. The problem with his tariff policies, in my opinion, is not the amount of tariffs. I think tariffs are actually not a bad way to raise revenue for the government. It's probably a better way to raise revenue for the government than to tax corporations or raise your personal income taxes. That's not my problem with that. My problem is that he is using those tariffs, it seems to me, as an ongoing negotiation tool, meaning that whenever he wants to get something, he is threatening tariffs. Now, if his goal is to get manufacturing back to the US, what you really would have to do is you have to say, look, these are the tariffs. Let's say they're 15% for all the goods. Get this through Congress and make it a law, and then manufacturers sort of can plan and adjust their supply chains around it. If you keep it loose and change those tariffs to a country and make it very, very fluid and change it based on your mood, I don't think a lot of businesses will decide to change their supply chains because they cannot really plan on it. They don't know what the impact of tariffs will be in the long term. So that's a little bit one of my issues with the executions there. But in general, I don't think it's a bad idea. Let me just make two more remarks on this. The first one is that obviously the Supreme Court is hearing today if these tariffs can stay on. The way I would think about this is that the Supreme Court is actually not deciding if these these tariffs are legal or not. What the Supreme Court is really deciding on is how these tariffs are going to be implemented. Because even if the Supreme Court is going to strike down some of these tariffs, there are other ways, other laws, other regulations that will allow these administration to put the tariffs back on. And at most, these tariffs will be gone for a month or two. But there are, again, other laws and regulations that will be employed by the White House to put these tariffs back on. That's my first point here. So it's not if we have tariffs or not, that's what the Supreme Court is deciding, is how are we going to put tariffs into place. The second point I would like to make is that I, I think we should get used to the fact that these tariffs are here to stay. Because Washington is very bad when it has found an avenue to raise taxes and raise revenues. These tariffs, these ways are normally here to stay. When the Trump administration in the first time put tariffs on, all of these tariffs were actually extended by President Biden because they liked the extra revenue. And so whatever tariffs will be put on by the Trump administration, and I think it will in the end settle around 12 to 15% of all goods, these tariffs are likely to stay in place. That's all on tariffs. Now, let me talk a little bit about what I see for 25 and 26. Obviously, a lot of the impact of these policies is not going to be visible for quite some time. We will not know if a lot of manufacturers are going to come back to the US. That's sort of down the road, but you need to know what I think or what might happen to the economy in 2025 and 2026. So let me talk about the rest of 25 first. And let me just say completely upfront, I have no idea. First of all, we don't have any data. The government has obviously shut down and it's not providing any data anymore. But secondly, the data that we have is confusing. On the left, you see the non-farm private payroll monthly growth. And this is based on the latest numbers that the government has released in September. And if you look at this very, very closely, you will find that we would have negative employment growth for the last 3 months if it wouldn't have been for education and health services who have added jobs. So all the sectors except education and healthcare were actually losing jobs. Manufacturing is pretty much close to recession. Housing is very, very close to recession. So you have a lot of indicators here that lead you to believe that a recession that is actually very possible, that we actually might be already in a recession at some moment in time. I would not be surprised if we found out in 18 months ago, by the way, we were in a recession during this period. On the other hand, and that's on the right side here, this is something that the Atlanta Fed is publishing almost daily. It's called GDP Now. It's a GDP tracker that has a lot of empirical history and has been very, very good in sort of predicting or telling us what GDP growth now is at this point in time. I just went on it yesterday. It's at 4%. So from that perspective, and I wouldn't be surprised by this either, the economy is actually hanging in there. AI is doing really, really well, and the wealthy are spending a lot of money, and the wealthy have the vast share of consumer spending in the US anyhow. And manufacturing and housing, we're in a recession probably for the last 2 years overall, or close to recession. So you could easily see this economy sort of hanging in there for another 2 or 3 months. I just picked up I love anecdotal evidence. I spoke at a conference yesterday in Washington, and it was more of a travel-oriented conference that wanted to have sort of an economic overview. But I always sort of speak to the people about what's going on in their business. And I spoke to somebody who was managing the Disney World hotels in Orlando, which are within the resort. And I spoke to somebody who represented the convention center of Las Vegas. And both of them told me the same thing. They told me, they basically made 4 points. The first point was the wealthy are still spending and their spending is increasing. The average American has cut back significantly. There are a lot less foreigners coming to the country. And they increasingly encounter hiring people for low-wage jobs because of illegal immigration enforcement. These were the 4 points that they were making. And I always find that interesting to hear what's going on in the country, and sort of that matches a little bit sort of what I'm seeing in the ground, and why I wouldn't be really surprised with any of these outcomes is that it feels like at least part of the economy are in a recession or stagnation, and then there are other parts who are doing really, really well. Having said all of this, I don't think it really matters because 2026 should be a lot better. Trump has really sort of set this up. It's a midterm election here, but he has sort of set it up very, very well to have actually a strong economy next year. One factor is sort of the lower interest rates that are coming. The Fed has already lowered rates twice this year, and it is estimated that they are going to reduce rates one more time this year and maybe 4 times next year. It might even be more because Trump is going to get his own Fed chairperson. Then the benefits of the big, beautiful bill are going to kick in. You will probably hear about this a lot more going forward in some of the other presentations, but personal federal tax refunds are going to spike significantly in March and April. It's estimated that these refunds are about 44% higher than this year, and the people are probably going to spend this, and this is going to give a boost to the economy. President Trump is sort of resolving some of the policy uncertainties already regarding trade. We got a trade moratorium, which lasts until the midterm election next year with China. The World Cup is happening here, which is the biggest sporting event in the world. You have people from 45 nations going to come in a lot of numbers to the US, and Trump is sort of using the stablecoin legislation actually to fund the deficit as well, because all the stablecoins have to be backed up by T-bills. And so this is going to provide about $220 billion demand for T-bills that otherwise wouldn't be there, just to back up the stablecoins. That if anybody wants to issue them in the US, they have to be backed up by this. So he is sort of setting this up to be a very, very strong economy. And I should stop here for a moment and say this is my base case. My base case is that the rest of 2025 might be a little bit challenging. It certainly looks a little bit challenging right now, but that it ultimately doesn't really matter, because the economy is going to get stronger in 2026. But I see two big issues out there that might make 2026 or 2027 a little bit more challenging than it looks like right now. And I wanted to sort of spend some time walking you through these challenges. I should say up front that one of those challenges, if that plays out, it will be his fault. The other possible risk, if something happens at that end, he will have nothing to do with that. So some of it is sort of self-inflicted, if you will. Some of these risks are sort of beyond his control. So let me talk about this risk. And let me just say up front again, I'm not predicting this is happening. I'm just saying it's possible that this is going to happen, and it would make the next 12 months, 24 months a lot more challenging. The first one is that we would have another wave of inflation coming. Inflation can come from two areas. One is you have an overheating economy, and the other one are external factors that lead to higher prices. And I think you have all things coming together here potentially. One is that the economy might be overheating. I talked about all the stimulus already, and I talked about that the Fed is going to lower rates. And let's just keep in mind, they have lowered rates twice already at a time where inflation is higher than desired. The Fed would like inflation to be around 2, And when they started to lower rates, inflation was at 2.7. That normally doesn't happen. Normally, the Fed only lowers rates when inflation is already contained, but it wasn't. So you could see that this economy is actually going to be quite strong. And then you have three other external factors which might add inflation pressures to it. The first one is that if you look at the tariffs and if you look at industry surveys, it looks like 50% of the tariffs, tariff revenue, if you will, or the cost of the tariffs, 50% of that has been passed on to US consumer, and the other 50% has been eaten by the producers and by the importers. It is unlikely that this is going to continue. Most of the times these costs will be passed on, so you could see another wave of price hikes just to pass on these costs that, again, producers and importers currently are eating. And then the other two factors are curbs in immigration and rising energy costs. Let me go into that in a little bit more in detail. And let me just say about illegal immigration. There's an issue about what is good for society. Do we want illegal immigrants? Do we want to deport illegal immigrants? I think this is a very, very legitimate question, and it could be, I don't want to judge it. It could be very, very beneficial for us from a society to actually deport all the illegal immigrants. That's not my issue. The issue that I have is, or the only issue I want to point out is that from an economic perspective, removing a lot of illegal immigrants from this country will be economically problematic. That's the only thing I'm saying. It's just a side effect of that policy. And the reason for that is the following. Look at the chart on the left. The native, meaning the American population that works, has been basically flat since 2022. So without foreign immigration, that is a black line, basically our labor force would have been flat. And it's very, very hard to economically grow without adding workers to the working pool, because that's part of, besides productivity, these are the only two ways how you can grow: increase productivity or increase the number of people working. And sort of just being flat alone is probably going to diminish growth. Secondly, if we are going to deport a lot of these people, is who is going to harvest our food? Who is working in farming? Who is working in construction? Who is doing the dishwashing work, or sort of the back work in restaurants and shops and in poultry farms and all of that stuff? If we lose these people, they have to be replaced by domestic workers who are going to charge higher wages, and higher wages is ultimately inflationary. You can see there's a study on the right here. It's an academic study that estimates if you deport about 1.3 million people, illegal immigrants, inflation is going to be up by about 1.5% higher by 2028. And if we deport 8.3 million illegal immigrants, which is estimated to be about 40% of all the illegal immigrants in this country, you would have a huge spike of 9.1% in inflation. So that is something that we have to keep in mind. Removing cheap labor from this country is going to increase inflation and lowers economic growth. The administration is actually quite aware of this problem, and the Secretary of Agriculture has come out and when asked, how are we going to replace these workers? And she said that she believes AI and robotics will take up the slack. I think that is possible in 3 or 4 or 5 years, maybe, if we make great strides into this. But at the moment, it is not happening. And so at the moment, this is a serious threat and another ingredient that might add to inflation going forward. The other problem that I'm foreseeing here, which might add to inflationary pressure is the amount of data centers that are going to be built in the US and come online. AI is a significant consumer of energy. And it's estimated that that the amount of global electricity consumption from data centers is going to increase by about 117% from 2022 to 26 to 1,000 terawatt hours. That doesn't mean anything. Let me just tell you what it means for the US. It would constitute the needs of about 24 million homes that we would add in the US and that would be added to the grid. That is a lot of energy, and it's going to lead through increases in utility bill, and we all are going to pay because they are another huge demand factor for this energy. And if you have looked at some of the utility bills, they have increased already significantly, and that is likely to continue going forward. And last but not least, there's history. If you go back to the 70s, that was the last time we had significant inflation in this country. It came in three waves. You had the first wave, and then it looked like inflation sort of receded. Then you had another big spike of it, and then you had a third wave. And then Paul Volcker stepped in and sort of he decided he would take a big recession, and that would sort of bring out the inflation out of the system. Again, it's not necessarily what I'm predicting here, but I think it's a risk here that inflation might pop up again based on sort of the four factors or five factors that I just mentioned, and based on history. Having said all of this, I also have the suspicion that a little inflation might actually be desired by the current administration. Scott Bessinger, the Treasury Secretary, has sort of indicated a little bit that inflation would make it a little bit easier to deal with the deficit. And let me sort of walk you through the logic here. We have reached a point where historically the Congress has taken action because the deficit got a little bit too high. You can see here that we spend about 14% of the budget right now on net interest expenses, and the deficit is about 120% on the right side of debt to GDP ratio. So it's a big number. It has increased significantly, and a lot of the debt that is coming due right now has been issued at very, very low interest rate and has to be refinanced at a lot of harder rates. So there is some pressure on Congress to get this under control. Let's be frank here, we are not going to pay down the deficit. We are not, this is just too painful to do that. The only thing that we can hope for is actually that we are going to bend the curve and get the debt to GDP ratio down a little bit. So the hope is then that if you grow the deficit slower than you grow the economy plus inflation, you get the debt to GDP ratio to levels that are more manageable. You are all CEOs and CFOs, so I assume right now that you're going to get the concept that what would be desirable is have the economy and inflation grow faster than the deficit. All of a sudden, the deficit is becoming over time a little bit more manageable. So when we look at where we are right now, we have about 2.3% average of real GDP growth, 2.2% of inflation, and our deficit is around 6.2%. That means sort of to bend the curve, you have to find about 2%. And you can obviously grow faster and find the 2% with faster growth. That would be very, very desirable, but it would be very difficult to do if at the same time right now we're shrinking the labor force because we're deporting illegal immigrants. So it's possible if AI actually is becoming very successful, but it's not likely at the moment. Then we could increase taxes and cut spending in Washington. That would also be desirable, but it's not likely to happen. We know that Washington is historically very, very poor in raising taxes or cut spending. And so the other way would be to have a little bit of higher inflation. And if you look at history, that is actually the preferred choice of many democracies. That's how many democracies have reacted to this exact problem when deficits were too high. That inflation let go a little bit higher, and over time you get it you get your debt to GDP ratio back to a level. And that is sort of my prediction. What I think is going to happen, and maybe what Scott Bessinger is trying to achieve here as well. And so if you get, that's just my best guess of sort of how we might deal with our deficit, is sort of GDP stays at 2.5, maybe goes to 3. You let inflation get a little bit out of control, but to keep it at an acceptable level, which would be 4%. And sort of you keep the deficit at 6, all of a sudden your GDP and plus inflation grows a little bit faster than the deficit, and so you bend the curve here. I think that is a very, very likely scenario going forward at some point, and the way it would be achieved is it would be that the Fed is keeping interest rates artificially low on the short end a little bit, which you can see already is a little bit happening. It has cut rates already, even though inflation was higher than desired. What that means is, from a business perspective, is that you would get a steeper yield curve. That means sort of lower interest rates would be a lot lower than higher interest rates. I'm sorry, longer interest rates. So shorter interest rates would be a lot lower than longer interest rates. That you would rather be a creditor than a lender. If you are a lender, that is going to be not good for you, because inflation is going to eat up a lot of the interest rates that you think you are collecting. And historically, that led to a weaker currency and a weaker US dollar. Again, inflation is not my prediction that it's going to be as bad as I sort of indicated here in 2026. It's not my base case, but I think it's possible that we are in for a period of higher inflation than we actually would like to have going forward. The other issue that I'm quite nervous about is that AI is in a bubble, and that it would be very, very bad for the economy if it pops. Let me just briefly sort of mention what I mean by a bubble. A bubble would be if you have a very, very good innovation like AI, you get overly optimistic about what this innovation is going to provide in returns going forward. The investments are going to be too high. The share prices of these companies are too high. At some point, it turns out that it's a great innovation, but it's not as profitable as you think. You have a mini crash in the market, and then it adjusts at a level that is more realistic going forward. I think that is, again, a possibility here. And I wouldn't have thought that we would be in a bubble until I sort of went through the Oracle example. And I thought to myself, oh my God, that reminds me of what happened in the 90s. So I don't know if you all remember, but at some point this year, the Oracle stock jumped in one day by 25%. Because OpenAI promised to spend $60 billion a year on data centers with Oracle. And on the surface, this sounds like a completely reasonable thing to be, is that if you have a new customer that spends $60 billion a year with you, your stock should jump. But as Michael Sembalist of JP Morgan pointed out, the $60 billion is an amount that OpenAI doesn't earn yet. It's not close to ever earning this at the moment, to provide cloud computing facilities that Oracle doesn't have and hasn't built yet. And by the way, it doesn't even have the money to build them yet. It still has to borrow that money. And all that data center is going to use energy that is not available yet. So it sounds a little bit optimistic, and that sounds a little bit like a bubble to me. We don't know if it's going to be a bubble or not, But this is sort of the kinds of things that people talked themselves into in the 90s. Historically, also, it is quite common that that innovations lead into a bubble. You can he says the biggest innovations over the last 100 years, and you can see that 75% of them ended up in a bubble. They were all great innovations like the steam engine and the airplanes, but all of them people get in the beginning far too excited about. And then in the end, it turned out they were great innovation, but it wasn't as profitable as initially thought. The reason why this is so important, and I have to rush a little bit because I'm sort of running out of time here, is that it is estimated by Harvard economists, and I've sort of looked through the numbers, they make sense to me, that 90%, 92% of the US GDP growth this year is actually happening because of AI. Which basically means that if we wouldn't have AI spending, the economy would have been flat or in a recession. It's an enormous amount of money that companies are spending on AI, and it's not quite clear yet if this is going to play out. If you do a back of the envelope analysis of what kind of revenues these companies need to get to make this a worthwhile investment, you come to the following numbers. You need 300 million subscribers paying $100 a month. 300 million subscribers spending $100 a month on AI. That sounds like a stretch. It's possible that we get there, but it is a big number. And so if it turns out that this is unachievable, you would lose obviously a lot of the investments that would fall away, and these companies wouldn't invest anymore, but you would also have a significant drop in the stock market. And the reason why that is so important for the economy is that this economy is supported right now by the wealthy. The top 10% of US households are spending, have a share of spending of about 47, 48%. The reason why they can do this is because they invest in the stock market, and the stock market is going to be going very well right now. If we have a significant drop in the stock market, that spending is going to go away. The investments of the AI companies are going to go away, and we could be in a serious recession. Now, let me just sort of re-emphasize this, and I'm skipping this chart just for time purposes. My base case is that we are fine in 2026. But I'm talking to CFOs and CEOs right now, and I think it's my responsibility to tell you what I think could go wrong. One is inflation, the other one is the AI bubble popping. It might be more a 2027 story. It might not happen in 2026, but that's what I would keep in the back of my mind. If I plan my business, if I set budgets going forward, there is a significant risk from these two fronts to the economy. And if they play out, it would be very, very disruptive. So let me stop here, Austin, and see if there are any questions or comments.
Thanks so much, Dr. Kloss. You've given us a lot to think about and a few things to worry about too. So
I'm sorry.
let me scan for some questions. So given the high energy needs of AI, how does it make sense that the US would curtail developing alternative to fossil fuels energy sources rather than pursuing both?
It doesn't. I mean, this is another one of my criticisms of Trump's plan, because we really need all the energy sources. It cannot be just oil, natural gas, coal, and nuclear. This is not going to be enough. We need wind, we need solar, and I know he doesn't like them, but it's really necessary that we get them. And that's another one of my criticisms of his policies, where I think the idea is right to promote domestic oil production, to get energy prices down, and that would really help all of us. But you really if you really want to do it, just let everybody get as much energy as possible. And unfortunately, he's not going to for that.
Okay. So would it be fair to say that you don't think we're currently overbuilding in terms of energy infrastructure? I guess
No,
some
I
people
don't
may.
think so.
Okay.
I think it's the kind of energy that we need is going to be huge.
Okay.
I mean, it's just amazing the amount of data centers that are being built right now. It's amazing how much energy they use. And by the way, they are very, very loud. May I just sort of, I don't know how many
Sure.
questions you have, but when we go back to the bubbles and back to the 99 bubble, there's one thing there are two things that are different, one positive and one negative compared to 99. The positive thing is that the Googles, the Facebooks, the Metas, the Microsofts, they have the money. They can blow through $400 billion a year on AI. If it works out great, if it doesn't, they are so profitable. It's not going to hurt them. So that's the positive thing is that these companies are fundamentally they can finance this out of their cash flow. The negative thing is, and I didn't realize this until 2 weeks ago, and so maybe I'm a little slow on this, but if you think about sort of part of the bubble was in that we put too much fiber in the ground, and it turned out we didn't need all that fiber, but the fiber was there to be used for the next 20 years. Now, AI is relying on CPUs, and CPUs get basically extinct in 3 years, and you have to replace all your CPUs again. And have to go back to NVIDIA and buy new ones. And so you don't have that much time to actually return on your investment of the first wave of CPUs. And that puts a little bit of time pressure in this to get sort of money out of this as soon as possible.
Sure. Very interesting. Very interesting. Um, what do you believe happens when a significant amount of white collar jobs start to be replaced by AI?
So it's a great question. It's a and the every economist is going to tell you that um, every time we had an innovation like this, it was initially very, very disruptive, but eventually other jobs came along. Right? When we went from horsepowers to cars, right? So you had all the people who were taking care of the horses and the carriages and were losing their jobs, and everybody wanted sort of what's going, but you found new ones. And so the historic expectation is that there will be new industries being developed who are going to replace those, but this one could be a little scarier and a little bit harder to do that, but the history is we'll find it.
Mhm. So we're in the midst of a government shutdown.
Yes.
How meaningful do you think this will be for the broader economy if it drags on? Is it more of a headline risk, political theater that executives listening in should just look through, or is it something that could start to weigh on short-term or long-term growth and
So
confidence?
historically, it didn't really matter because what basically happened is you had a little bit of disruption for 30 days. And then after the 30 days, everybody got their back pay. And so all of a sudden, there was a lot more money back in the accounts and they started to spend it again. And so it turned out to be a wash. And so of all the issues we have right now, I think that's not that big of a worry. I would also say that both parties probably thought they're winning the PR battle with the shutdowns, and they didn't want to give in before the election. That happened yesterday. I think after this election, there's a lot more willingness to get this done and move on because some party suffered, the other party won, and so I think we are probably getting closer to the end now.
Okay. And we have about 1 minute left. So, what would be that one thing, or maybe one or two things that keeps you up at night if you were an executive at a small, mid-sized business that you'd be looking at in the economy for signs of what to do next?
Um, so the best data set that I always look at is weekly unemployment claims. Every Thursday, when the government shutdown is over, we get this number again. Every Thursday, you see how many how many people are filing newly for unemployment. And right now, the last number we saw was about 220,000 every week. That's perfectly fine. But if that number ever goes to like 260, 270, that's normally when the economy is hitting trouble.
Very good. Very good. Well, Dr. Kloss, thank you so much for your insightful presentation and the thoughtful discussion. You certainly gave us a lot to think about. We really appreciate you sharing that perspective with us today. And thank you to everyone who joined us virtually for being part of the conversation. We hope you enjoyed today's keynote and the rest of the symposium sessions ahead.
Thank you, Austin. Good luck to everybody.
Thank you.